Brian, it's good to see you. Welcome back to the Halftime Report.
Thanks so much for having us.
News I mentioned today is that you've cut your target again. This time it goes to 4,300, and you've taken your earnings down to 230. So, yes, it's a cut, but it's still fairly optimistic. I know that sounds like a ridiculous understatement, given where the S&P is at 3,600. How are you going to get 700 more points?
Well, again, thanks for having us. And to be frank, we probably should have cut to add to 4,300 the first time around. So I sincerely apologize for that. I do, because we've been wrong. And our big piece of the puzzle that we've been wrong on is that inflation has been stickier than we thought. On the earnings side, earnings are tracking still around $230. Right now they're at $222, $223. And per Shannon's comments, you know, what's really interesting is that the guidance really hasn't changed yet, and we're looking for around 3% for this quarter, just like we were last quarter, and numbers came in around 7%. So this insistent under-promise, over-deliver on a near-term basis, I think is going to continue. I think the big issue, quite frankly, is going to be 2023. And because we're not seeing guidance, and because we're seeing sales growth over earnings growth this quarter, I think companies are having a hard time really contributing or attributing, what growth is going to look like in a persistently high inflation environment where Mr. Farr is absolutely correct. The Fed is going to continue on. So that's why the cost of capital is where it's at in terms of our estimates at 8.9%. What's really interesting with respect to seeing the cost of capital go up, if you go back and do the work historically, we need to see the 10-year Treasury go to 6% to get a 9.7 cost of capital. Actually, the next move in the Treasury market to 5% means the cost of capital historically goes down. So I'm not of the belief that earnings are going to $200 this year. Next year might be a different story, but I do believe 2022 is officially now the reset with respect to the markets, and then we transition more into normalized returns and normalized earnings growth in 2023 and 2024, but we may have a lot of volatility in between.
I know, but you just said, right, the Fed is not stopping, so how still forget earnings? Let's just take it, Fed not stopping, how are stocks holding up or rallying, which they need to do to even get in the universe of your target?
Great question. If you take a look at bear market rallies historically going back to 1950 or so, you typically see a 30% rally from the lows, and it takes about 3 months. We're running out of time. And I think we could see 10 to 15% pretty easy and get close to that 4,300 just because of sentiment. Everyone's bearish. We keep talking about bearish. Now is not the time to sell. Now is the time to be a stock picker. But if we see a rally, you may see me come back on this network and tell people to sell. Because I do know, that guidance is not going to be good for next year. Companies are not talking about it yet. And I do think you're going to see earnings depletion. However, here's where I think the market could be wrong, and it's always dangerous to say it's wrong. If you go back in time, historically back to the 1920s, and do an historical regression in terms of PE ratios out of a recession, PEs actually go up when earnings go down. And so we could have a situation where the market levels could be flat for the next year or so with earnings going down, but multiples a little bit higher as the Fed later on next year actually begins to pivot and lowers interest rates. But in between there, we're going to see continued pressure with respect to 10-year yields and in respect to higher interest rates, which is going to spook market.